Hi, I'm Vic Rader. I'm a realtor, licensed for 16 years. I was 23 years in the aerospace industry, and I thank you for coming out today. Let me jump into the agenda here. This is kind of out of, let me just jump this up here. What's the financial challenge facing most Americans today? Why should you listen to anything I've got to say? Why real estate? And the core of the presentation is what are the 6 fundamental benefits that you need to understand that if you're going to do a total return on investment calculation, which I call a comprehensive return on investment calculation, you need to know what those 6 things are and whether they contribute or not. Most people don't know that, so you're going to know that today. And also, how many people have been to a seminar and they got all excited or they read a book and they were motivated, but then 2 weeks later they forgot about it? Everybody. Me. You know, I can go to a real estate conference and here's 99 ways to make money in real estate, and you go back and you're all excited, but then life happens and you get busy and who's got the time? So I'm going to really encourage you to take action, do something. The easiest thing to do is we're going to offer you a free game plan because it's really simple and specific to you. Everybody's different, everybody's situation's different, and that's the easiest thing you can do. After all these years of doing this, I finally got to the point where I felt like I knew enough to give back and actually teach other people, even though I finally figured out I'm never going to know everything. So I don't know everything, and I'm not a CPA, I'm not a tax advisor, attorney, financial planner, money manager. I'm a licensed realtor with a lot of education and hands-on experience. I've done it, I've been there, done that. So I don't know everything, but I know a lot more than most people, and that's what I'm going to share with you. So what are the challenges? Well, where, when, and what to invest in to achieve the highest return on investment with the least amount of risk. That's basically what most people want. If you have any money left over to invest, that's what most people are looking for. So how do you decide where to put it? What about cash flow at retirement? What are you going to live on? How much do you need? Where's it going to come from? Do you have a plan? If you have a plan, who came up with that plan? Is your plan on track? How would you know? Are you just kind of winging it and doing the best you can? I find that that's what most people do. What's your decision-making process? What's your source of information? How about information overload? There's no shortage of information. That's not the problem. The problem is, what does it all mean? And who do you trust? Who's got the time to deal with it and figure it all out? And my favorite, as an engineer, as a recovering engineer, paralysis by analysis. Okay, I could do this all day long. Okay, why should you even listen to what I have to say? I want to give a little bit of, who am I? Who am I? I'm old. So you can learn from old people who have made a lot of mistakes. I could write a book on what not to do or what to do. If anybody can write a book on what to do, it's because they can tell you what not to do. You learn more from your mistakes probably than you do your successes. So I'm old. That's a great benefit. I've been married for 24 years. I got 2 kids off in college now. I was born and raised in North Carolina. I graduated from North Carolina State University with my electrical engineering degree in 1978. I went to work in the aerospace industry in Southern California for 17.5 years. 1980, kind of interesting year. I read a book and I bought a house. Now, I'd just gotten out of college and I didn't know anything. But I read this book and I talked to 2 guys at work who said, what have you got to lose? Invest in real estate. Because I didn't want to rent. I just didn't want to pay rent. I wanted to own my own home and have a garage and all that kind of stuff. So I didn't know what I was doing, but I bought a house. And that was a life-changing thing. You look back, that was one of those life-changing things that started me on my journey of owning property, which has really turned to a passion. I was 23 years old. Well, since then I've bought 11 homes and sold 2 personally. I currently own 9 rental properties, and I've got 28 years of experience in property management. Now I want to say every little topic I bring up, that could be an hour discussion, easily. So all I'm trying to do here today is in 1 hour give you what I think are the most important fundamentals about investing in real estate you ought to know to start the process. You're not going to know everything, but at least it'll start the wheels turning. I moved to Redmond in 1995, basically to stay home and support my kids and support my wife's career. And then so I always want to get my real estate license and do that on the side kind of thing. So I got my real estate license in '97 while I was home with my kids. When my daughter went into 1st grade, I went back into aerospace. And actually, we were doing pretty well. We're both working. We're maxing out on our 401ks and all that kind of stuff, good income. I owned a couple of rental properties. I kept all the properties that I'd bought. I kept them as rental properties. That was part of my plan. And so everything was going great until 2008, when me, like a lot of people, didn't see this coming. I got laid off at the end of 2008 when the recession hit. And it hit aerospace big time here in the Northwest. Dow went from 14,000 to 6,000 in about 9 months. So my 401k went to a 201k or more, you know. And so I got into sales, and you know, I did really well. I mean, the first thing I sold was my Infiniti G35X. Then I sold my boat, and then I sold my Ford F-250 crew cab. So I had some big sales that first couple of years. Of course, nobody was buying real estate in 2009, 10, and 11, so it was pretty rough. But here's what happened. The silver lining was, yeah, I got to spend more time with my kids, but I also realized, you know, motivation comes from inspiration or desperation. And as human beings, it's been proven over and over again, we'll avoid pain more than we'll seek pleasure. And so the pain of looking forward and finding out that my plan, well, I thought I had a plan, but I never penciled it out. So I sat down and ran some numbers, and I found out, uh-oh, this ain't working. And now I don't even know if I can get a job. I'm the unemployable generation. If you're in your 50s now, you're called the unemployable generation. There's tons of us. Baby boomers, 68 million. But because I've always been passionate about real estate, I did realize we're looking at, you know, when you have a disaster, you know, like the economy going through this recession, that creates opportunity. The opportunity in this case is real estate. So I saw it, and historic low interest rates and historic low prices based on every metric you can come up with. This is the best time that I've ever seen ever to buy real estate, and probably ever again. So I wanted to jump in. So what was really interesting is, with all the stress going on in my life, it was hard for me. So first of all, if it's scary to go buy real estate because you haven't done it before, you're thinking about, oh, I would never buy out of state and things like that. I've been there, done that, but I believed in the real estate. That's what really made me do it, and the fact that I joined a company I'll talk about later. If I hadn't done that, I probably wouldn't have done it because I needed the support. Okay? So I purchased 4 properties in the second half of 2011. Those will be in the end of the day, those will be the best investments I've ever made, hands down. Okay? Just on appreciation alone, I'm going to talk about 6 things. Everybody knows appreciation. I've doubled my money in less than 2 years on every property I invested in because I financed them. I bought another one in 2012, another one in 2013 so far, and I really want to buy more now. Now, you can buy real estate for the next 30 years if you buy on the model I'm going to show you, and you'll always make money, you'll always come out okay, it'll always be low risk. But if you can buy now, wow, I mean, take advantage of the appreciation upside as the icing on the cake. That's one of the things I'll talk about. So this is kind of an analytical presentation, but I've tried to gear it toward, here's the bottom line, and then I'm going to show you some math. But if you doze off or you glaze over during the math, I do want to give you an example of why real estate. Because we're not taught to build cash flow up over our lifetime. What we're taught is you build up your net worth. So you invest in the stock market, you want to grow your net worth, so you're worth millions of dollars someday. But then you have to turn it to cash flow. I've got news for you. There's another completely different strategy. You could be 20 years old and you could build cash flow your whole life. You could just focus on building more and more and more and more and more cash flow. So here's an example. Now you can scale this up if you want, but you know, in the old days people used to say, hey, when I retire I'd like to generate $50,000 a year in passive income. Now they say 100. So just double this. At 3% inflation, if you had 15 years to go, you're going to need, that's about $78,000 a year. 50 today, in today's dollars, when I retire in 15 years, I want to live like I am today on 50,000. Okay? You're going to need about 78,000 based on 3% inflation. I don't think that's some crazy idea. I think all my numbers are pretty conservative. You're going to need about 1.2 million to last 16 years. That'll take you to age 81 if you retire when you're 65. Right? Now that's with an 8% growth over the next 15 years after tax. I think that's pretty good. And then after you retire, you're going to go into a more conservative investment, and I put 4% growth over those next 16 years. Okay, so you put this into a spreadsheet, and you start out, you've accumulated this much money, and the year one you take out that much, you've got that much left over. It grows at 4%, and you do it again. You do this all the way down 16 years, and you got $79 left. So you run out of money, and you die broke. That's the die broke plan. Most of the plans that I've seen that involve saving up money, people can't save up enough money to get enough return to keep the principal without drawing down the principal. So most people are on a die broke plan. This is somebody that's doing well, by the way. I mean, the statistics now of people turning 65 and relying almost 100%, 25% are relying 100% on Social Security. Most people can't write a check for $500-600. That stresses them out from their checking account. So this is somebody who's actually, looked ahead and actually, 1.2 million is not, that's not crumbs on the table in 15 years. But a lot of people these days would say 50,000, I want 100,000. Okay, double it. Now you need 2.5 million. And you're still going to go broke. I mean, that's still the go broke plan. Now here's real estate. It's a little simpler because rents and the value of the property go up with inflation. So it's kind of automatically included in your planning. So what you can do is you could say today, if I wanted $50,000 a year, how many rental properties do I need to own? Okay, so 15 years from now I want to own this many rental properties paid for that generates X amount of cash flow, 50,000. So I figured this out. And based on the case study that I'm going to use, because this is properties I know I can go buy today, I would need 5.34, I'm going to call it 6. I'm not going to buy 5.34 properties. I'm going to use 6, which would give me about $56,000 a year in retirement income. Okay? So that's not that complicated. I showed the math of how to do it. So if I bought these 6 houses, that's $960,000 worth of assets that I'm controlling with an out-of-pocket cash today of about $240,000. It's about $40,000 each to buy the property, set it up with positive cash flow. You know what I'm going to do is I'm going to let the tenants retire that debt over the next 15 years. That's totally doable. This is a very conservative plan, by the way. There's other things you can do. This is very conservative. Okay, so by the way, if the real estate goes up also with inflation and we use 3%, over the next 15 years, your net worth is going to grow to about $1.5 million. And then you retire and you start taking this money out, and it'll continue to grow. All right, let's compare these plans. This is the Save Up plan. Invest about $386,000 today. Get an 8% after-tax growth rate for 15 years so you can save up the $1.2 million you need, withdraw that money in today's dollars, $50,000 a year, and then you'll run out in 16 years with 4%. These are all just based on assumptions. This is modeling. And then at 81, you're out of money. Most people are out of money already by their 65 or 70. I mean, this is actually somebody who's planned ahead and they're going to do better than most people. Here's a real estate plan. There's a lot of people that have $300,000, $400,000, $500,000 in their 401ks, and you can actually buy real estate in a 401k, self-directed. That's a whole other discussion. But let's say you just pulled that money out and you invested $240,000 today to control $960,000 worth of real estate. And then you took these, there's nothing crazy in here. This is not a get-rich-quick scheme, okay? I'm going to let the tenants retire the debt. That's the simplest plan there is. I'm just going to live on inflation-protected income till I die. Does that sound good? Does that sound better? Okay, now my net worth over that period of time this is better. I mean, this is better. I've got $1.5 million in net worth. It doesn't really matter because I'm not going to use it. I don't need it. It's a nice thing to have, though, because I can get myself a raise. Because over the next 15 years, if I keep going, by the time I get to 81, like in this case, I die broke. Well, now I'm still living off my today's dollars, 56K. But now my net worth is 2.4 million. Over this period of time, I could actually get myself a raise. Or when I die, I could leave something to my kids or a charity or my church or whatever. So the people who are going to glaze over now when I get into the math, this is why real estate. Fundamentally, this is why real estate. And there's a lot of stuff embedded in this. These fundamentals I'm going to talk about are all embedded in why this happens. Okay? So how do you go about making these intelligent investment decisions? Well, you need to start with a goal. You need to understand the fundamentals of whatever it is you're going to invest in. You got to develop a plan then based on those investments. Choose the investments based on the plan and always be able to answer these questions. Where's my profit coming from? What's the risk? What's the worst case? And instead of just shooting from the hip and going, well, I'm trying to do the best I can, how does it fit in with your plan? And do the math. I don't have to debate anybody about this versus that. I always just say do the math, and if it makes sense, do it. And if it doesn't make sense, don't do it. Of course, how would you know if it makes sense or not if you don't have a plan? If your plan says, I got to get 20% a year in the stock market for the next 15 years, do the math. Are you going to get 20%? I am in real estate. Okay, let's get into the core of the presentation now, which is really these 6 fundamental benefits I talk about. Most people teach 4 or 5. I added one because of the way you do the calculations. Now, I got this ideal courtesy of Doug Richards. I've learned from a lot of people. Tom Ludstead, Walter Sanford, Joe Still, Doug Richards. I've read a lot of books, I've done all the seminars, and I try to give these guys credit because they're all great, and I recommend all their stuff. I've bought all the material. The first is instant equity, because investors buy below market value or replacement costs. That's just what all the investors want to do. They want to get a good deal. What's a good deal? The first step of a good deal is, if you can get below market value, you buy at a discount. So, you know, maybe 95 of real estate is being sold at market value or above, but there's always real estate being sold below market value for depending on the motivation of the seller and things like that. There's always ways to find that. The second is income, which basically stands for cash flow. Depreciation stands for tax savings. Equity stands for principal reduction, the fact that you're amortizing the loan and the tenants are buying you a house. That's a very important strategy here, especially when you get into compounding. Go study compounding. Compounding alone is fascinating to me. Everybody knows appreciation. That's it. It goes up in value, and this is what 98% of people, and every article you read in Money Magazine, Forbes, or anything to do with real estate, it's all focused on appreciation. What I'm going to show you, by the way, is how you can make a good, solid, long-term investment in real estate if it never went up in value. I didn't really say that, did I? Did I really say that? It's true. So you take the risk out of it. You take the speculation out. You invest with a worst case 10, 12% return, and then if you can buy now in a rising cycle with leverage, yeah, you can get 65% of return next year. And the next year maybe 35 or 45. You can get these big, huge numbers. I'm talking about in the long term. This is hitting base hits. Depending on what, I'm just talking about base hits all your life and stacking this up. The last is leverage, which might be the most powerful thing there is, the most powerful principle that you can take advantage of in real estate that I don't know, that doesn't exist in other investments like it does in real estate. Let me give you an example. One way to get started in investing in real estate is you buy your own home and you live in it. With the plan, you buy a place that you plan to rent out. What does it cost to get into that home? 3% down. If you're a first-time buyer and you make less than $97,000, there's financing programs. You can get in with hundreds of dollars out of your pocket. What investment? And then you're controlling an asset worth $200,000. You live in it for a year and a half, and you rent it out. So that's why leverage is incredibly powerful. So let's talk about, most people make a decision based on, well, tell me what the return is. Because most people talk about the stock market or whatever, and you hear this word return all the time. What's your rate of return? Well, basically, it's what you got out of it divided by what you put into it. This is really, just remember this concept. Because how do you get a big return? Either this number gets real big and this number gets real small. The smaller this number, the bigger your return. So just remember that concept. So the math really doesn't have to be that hard and complicated. The challenge is really predicting the future. Who can predict the future? And just making the decision where to put your money. So now I'm going to get into a little example just to illustrate return on investment, how simple this is. Again, return on investment, the profit or loss divided by the investment. That gives you a percentage. You use annual numbers to get annual percentage rate. So when most people use the word, what's your return, they're thinking how much in a year. Most people put this in annual numbers. If you do happen to hear, I made so much per month, multiply it times 12. So just look at stocks and bonds. If you look at stocks, basically most people, if it's growth stocks, they're just looking at how much did it go up in value. That's the appreciation. That's your return. If it's for cash flow, like bonds, they talk about the yield. Well, that's the return on investment. So in either case, let's say you put $100 into an investment, and a year later, you either got a $10 increase in value, now it's worth 110, or you got $10 of cash flow. In either case, that's a 10% return. That make sense? Okay, so when you understand these fundamentals and your strategy, depending on where you're at in your game of life, if you're in the first quarter versus the fourth quarter, if you're in the fourth quarter of a football game and you're way behind, you're throwing Hail Marys, man. You're taking more risk when you wanted to, at the beginning of the game, where you hoped to end up is, you're making really conservative plays, right? You're not throwing Hail Marys. That's why planning is so critical. Okay, so how do you measure your rate of return now in real estate? Well, here's the approaches. You can measure your return on investment based on just the cash flow, just the increase in equity, the value of the property. You can do a combination of cash flow and equity. You can do a one-year snapshot, which is using today's number and simple division. That's what I'm going to go take you through an example. You can also get into all these multi-year projections. Obviously, I'm not going to do that in an hour. I know how to do all this stuff. I think it's really interesting. But at this point, you know what? You don't really have to do all this stuff if you understand all the fundamentals and you've got a plan. You can also look at stuff pre-tax and after-tax, because depending on your situation, you have to know what are your tax advantages. They might be nothing really. They're all pushed off into the future. Or they could be significant, very significant. So I don't want you to get caught up in the weeds. This is, remember the big picture as we dive into some math here. So all I'm going to do is I'm going to go through an example. I'm going to take each one of these benefits, okay? And there's 5 listed here because I lumped together, let's see, cash flow, principal reduction, they're paying off the loan, tax savings, instant equity, and appreciation. And I'm just going to divide it by the total cash invested. Real simple, one at a time. I'm going to use annual numbers so that I get that annual rate. And in my example, I'm going to leverage the purchase, so I take advantage of all these things. All right, so here's just on cash flow. Here's how we do it. We take our gross rent minus our vacancy minus our expenses. Rent comes in, you've got to pay your expenses. It's not going to be rented all the time. What you have left over is called your net operating income. Now, if you finance the property, you've got to pay off your mortgage. So you subtract your debt service, and that's what we in this industry call the cash flow. Starts out cash flow before tax, CFBT. ADS just stands for your annual debt service. So that's your monthly principal interest payment times 12. Now your total cash invested, if you're paying cash, it's just going to be the purchase price plus other cost of acquisition. If you finance, it's going to be the down payment plus your other cost of acquisition. So if we pay cash, our return on investment is called the cap rate. That's what your yield would be based on just the cash flow if you bought a property with none of the other 6 things I'm talking about. So it's just your net operating income divided by the purchase price plus the other cost of acquisition. And I spread that over 5 years when I'm doing a one-year snapshot. I don't want to take the hit in the first year, good or bad. So those little things, I actually just kind of spread them out and divide by 5. Because for me, I know I'm going to keep the property at least 5 years. If I leverage it, it's cash flow before tax divided by the down payment plus the other cost of acquisition. Okay? So really, once you've done this for a while, the hardest part is really, it's like your taxes, it's gathering all the information. So let's get to an example. This is a property that was available in Phoenix just recently for about $160,000, rent of $1,250, a nice little house built in '93, a little over 1,300 square feet, 3-bedroom, 2-bath, 2-car garage, pool. This is a typical home in Phoenix these days. This is in Mesa, which is this is not out in the boondocks. This is a good cash flowing property. So first you have to pull the data together. You always have to do this. I'm sorry, but you have to do this. So in this case, the purchase price is $160,000. I put a $1,200 a rent. You may have noticed it said $1,250, so I'm being a little conservative. So I'm going to calculate my net operating income as $9,300 a year. I'm going to finance it. So I figured out the debt here. I'm going to finance it basically in today's numbers. And the bottom line is I got $1,800 a month of cash left over at the end of the day. Okay? Now I also put in here, based on the way I financed it, in 1 year I'm going to pay down the loan about $2,000. I bought it $5,000 below market value. That's also very doable. And I'm going to use a 6% appreciation for a year, actually just market appreciation. This is really conservative. When you do these models, You know, you can use real numbers or you can use conservative numbers. I like to use conservative numbers. Phoenix went up 30% last year. Vegas did about 23. They're going to probably do 15, 20 the next year. But I use 6% in this example to make it more generic and conservative. Now I'm going to talk about depreciation pretty quick, but depreciation is a non-cash write-off, which is awesome. And I just set this up to take $20,000 for the land and $140,000 for the structure to simplify my example. So here's our first calculations for return. Okay, my cap rate, remember, is the yield just on the cash flow, no financing, no instant equity, no appreciation, no tax savings, no principal reduction. I get 5.8%. Okay, that's about double. If you're really conservative, you don't want any risk, and you're older, you might be investing in bonds or stock paying dividends, you might be getting 3 or 4%. So to me, this is kind of the worst case scenario for a return in real estate. You pay cash and you get about 6%. And that's about double what you're going to get in something else. The difference is it's got built-in protection against inflation. Now, if I finance, that's called cash on cash. I get 5.4. You just have to run the numbers on every example. The lower the property, the price of the property, generally you're going to get a higher cap rate but less upside potential. And as you move up and you get more expensive properties, you just have to run the numbers. And your cap rate's probably going to go down, but your overall return might go up. Okay, now I'm going to add principal reduction. Remember, the tenants are buying you the house. So in the first year, they dropped your loan balance by $2,000. That's not cash flow, that goes into your net worth. So if I just add that to the numerator, now I'm up to 11.4%. So you can see that by financing and using leverage, I've just about doubled my return. That's the power of leverage. Now I'm going to add my tax savings. And you'll really have to see if this applies to you or not. It depends on how much money you make. But when you calculate it on your Schedule E, when you do your tax returns, your taxable income is your net operating income. That was how much money you left over. And then you take your write-offs, just like in your mortgage interest deduction. You subtract your interest, just like you do on your own home. Remember, net operating income's you've already written off all your other expenses, unlike your home. You've written off all the repairs and maintenance and advertising, commissions and property management fees. You've written all that stuff off, but you also get to take off the interest and depreciation. Depreciation is a non-cash write-off, so the tax code is very friendly to real estate because it's significant. This is how you set up depreciation. The land is 0, residential structures 27.5 years, property improvements 15, straight line, and everything else is called MACRS, Modified Accelerated Cost Recovery System. So like if you had your appliances, you might write those off over 5 years. So you really can maximize your depreciation write-offs in the first 5 years. Now, I just want to make you aware that in my example, I'm assuming what's called active participation, or you're a real estate professional. You'll really need to talk to me or your tax attorney to get into more details here. The other thing, though, besides affecting your cash flow that's significant about real estate is if you're buying any investment because you want it to buy low and go high and then sell it and then do it again, it's a taxable event. You have to pay tax on it. If you've kept it over a year, it's long-term capital gains. It's 20% for most people. With real estate, you never have to pay tax on the gain. If you keep the investment in real estate, you continue your gain. It's called a 1031 tax exchange. That's another couple-hour discussion. But you never pay tax ever on the gain of the sale of the real estate if you keep it in real estate. So that's huge. So based on these assumptions and my taxable income, I'm going to use a 30% effective tax rate to determine do I have to pay tax or did well, first of all, my taxable income came out to be minus $1,100 a year. Now wait a minute. Didn't I say I had $1,800 a year? Yeah, I had $1,800 a year, about $150 a month, of money left over when all was said and done. But on my taxes, I'm showing a loss of $1,100. Why is that? Oh, well, that's caused depreciation. It's really caused depreciation. Depreciation shelters your positive cash flow from taxation. So if you are able to take advantage of this, you're not paying any taxes on the income from your rental property. Just think about your job. You know, you get paid $1, you might pay as much as 50% in income tax to the federal government and state. We don't have state tax in California, but it can easily be 35 to 50%. So you're only keeping, 50 cents to, on $1. The money from your rental property, you keep the whole thing. That's why it can be very significant to your cash flow. So in the end, I got this $338 tax credit versus paying $990 in taxes without the depreciation. That's a difference of about $100 a month. Okay? So now I'm going to do my calculation. I'm going to add that in. Now, depending on the numbers, maybe I owed tax. It's just you have to work the numbers out. I have a property I've had for so long. Back when I did it, the depreciation schedule was 17 years straight line, so the depreciation is all gone and actually show a profit now. A small profit, but actually show a little profit. And there's ways, so how do you calculate? There's so many strategies in real estate, but if you've got properties that are making huge profits because you paid cash and you don't have that, you can diversify. You could get properties over here and leverage them and have big losses that shelters all the gain. So there's all kinds of strategies in real estate. But anyway, I add my $338. It's not very much. But the point is my after-tax return on investment actually went up, not down. And so I don't know how many you're going to find investments where you can have a taxable event and your rate of return went up. I don't know of any, except real estate. But I'm not an expert on the stock market and annuities and commodities and currencies and everything else. You invest in what you understand. So now let's look at instant equity and appreciation. You don't see these in your cash flow, so I put them together. I'm just going to add these divided by the investment. So I had $1,000. I bought it for $5,000 below market value. So I'm only taking credit for $1,000. I had $9,600. It went up in value over 1 year based on 6% appreciation. I'm just curious. I mean, how many people think that's crazy or realistic or conservative, considering they just went up 30? I mean, a lot of people think we're going to have inflation is going to be who knows what. Anytime you're looking out and projecting into the future, you're speculating. Okay, that's always going to be the case. But you can see here that if I'm leveraged, this is what I put in the denominator, a lot less than this if I pay cash. So I got 32% versus about 6.5%. That's the power of leverage. Now, if I go back and look at my total, now I can add these all together. Remember, I had my cash flow. Up here, my principal reduction, my tax savings, my instant equity, and my appreciation. Those are the 6 things, all lumped into 5, divided by, if I leverage the property, 44%. Now, if I paid cash, it'd be 9%. That's how you calculate your return on investment with a real estate property in a 1-year snapshot. I can show you how to do all the other fancy stuff, but this is really not that hard to do, and this is what you need to know. So it's really critical that you understand, if you're talking real estate, unlike a stock, a growth stock, all you need to talk about is, did it go up or not? It's all appreciation. If you're talking about rental property and somebody says, what's your return? For me, that's a loaded question. If somebody said, I got 18%, I'd say, how'd you calculate that? I mean, if you don't know how they calculate it, it's almost meaningless to me. Most people think that the appreciation, that's their return. Particularly financial planners are guilty of this. I've run into some financial planners that manage a lot of other people's money. And they've told me real estate's not a good investment because the stock market has outperformed real estate historically. And I'm going, whoa, oh wow, And they say, oh, since 19 so-and-so to this year, it got an average of 12% appreciation, and real estate only got 6%. So see, stock market's better. This is very conservative, and I'm blowing those kind of numbers out of the water. Okay, so just be very careful now from now on, now that you know all this, when that word rate of return or return comes up to do with real estate. Let's just summarize. Our cap rate was 5.8. Cash on cash 5.4. Now with the cash on cash, if you've leveraged and you're amortizing the loan, which is what I recommend, you're not doing interest only or something like that, you're paying down the loan. So I always recommend that these go together. So this is really what I look at. And I got 11.4 on this property. Tax savings, hey, icing on the cake. Instant equity and appreciation, you got 44%. To me, that's the icing on the cake too. You know, I don't plan to buy all my properties this year. I can't. So yes, we're in a rising market, and that's all fantastic. But you know, I'll keep buying properties forever. I mean, that's kind of my plan. And how will I make? But what's the criteria that I'll make a decision? Because at some point, if things go up and then they go down like crazy, you're thinking, well, I don't want to buy then, right? Well, yeah, you don't. But how do you know? Who can time the market? The only people who can really time the market are investors who make their decisions based off numbers and trends. Numbers and trends. So if I'm basing off this number, I can make a decision here to buy or not buy because I don't really care if the property ever goes up or down. If that's my goal, my criteria is I want over 10% return on my investment just based on the cash flow and the fact that the tenants are buying me the property. And I'm happy with more than 10%, I don't really care about anything else. Property goes down, property goes up, I don't care. By the way, I have to point this out that what's a realistic number for next year's appreciation? Because if I put 15% in here, this 44 goes to 87. Okay? And that's why I'm saying, this is not going to last forever, but there is kind of an urgency right now. If you want to take advantage of, if you understand cycles and these, 8 years up, 5 years down, the last cycle is 15 and a half years. We're 1 year into a rising cycle. I can't predict, all I can say is historically this could be 6, 7 years of rise before we have a correction. And the next event happens and who knows what. But it certainly is a great time to buy if that, is part of your plan. It always depends on your situation. It's a good time to sell right now. It's a good time to buy. Well, the answer depends on your situation. I'll just throw this really fast in here that if you look at you're investing in real estate over the long term and you keep doing this calculation of your return on investment, it's kind of fascinating to me, the power of compounding, because you can see what happens is over time you become less leveraged and your return actually goes down. So out of here at year 15, you can see here between 7 and you kind of, right in this time frame here, this is why a lot of people, they want to turn their real estate properties every 5, 6, 7, 8 years because they want to start this over. That's just like buying growth stocks. I want to get a big return, then I'm going to go do it again. Get a big return, do it again. You can do that in real estate too. If you hang on though, look at the power of compounding. Look at your net worth taken off. So the power of compounding is pretty amazing, okay? So, you have to look at the whole picture. So here's my investment rules. And first of all, planning is critical to success. We never would have put somebody on the moon by accident. Success is not an accident. It comes from planning. And what quarter of life are you in? That's all your risk and how much and all this kind of stuff. And this information can be helpful to somebody in their 20s or somebody in their 50s. Buy a property you can keep forever. That way you're not stuck with it. It's a lot easier to buy them sometimes than it is to get rid of them, right? If it's a dud. And that's all about timing. Maybe those are strategies I really don't have time to get into. But anyway, that way you give yourself that option to re-leverage downstream. Okay, the properties I'm buying in Phoenix, I'm buying them because they've got the 10, 12% return or more, but they have huge upside potential. But they're properties I can keep forever, pay them off, I'm happy. But you know what? Probably 5, 6, 7, 8 years from now, I'm going to have this big pile of money called equity, and I can sell those properties, do 1031 exchanges, and I can take one property and go somewhere else in the country and get what I call cash flow keepers, where the cap rate is 10%. And they're paid for. That's my exit strategy. That's just my own personal exit strategy. I can take one property and go buy 3. Take one property and go buy 3. And so that whole analogy at the beginning to do the 50,000, own 6 properties. I own 6 properties I just bought recently. I'm on that plan. But the reality is I could end up owning 20 properties paid for. They're smaller properties, but they have a higher yield. They have better cash flow. So my cash flow goes way up. Target properties below median price, and you want to buy below market value and or replacement cost. That alone doesn't make it a good value. Some people think that's a good deal. Avoid high-risk properties. Limit your rehab to the cosmetic fixers if you want to minimize your risk, and only use positive leverage, which results in positive cash flow. Okay, how do you do that? Well, if you're just doing some quick analysis to determine what to pay for a property, make sure your cap rate is more than the cost of the money. That's what's going to lead to positive cash flow. And you take a shot at, for me, I think a good number to shoot for is your cash on cash plus principal reductions greater than 10%. Because that's kind of worst case forever, inflation protected. No arms, no balloons, no negative amortization in your lending. Okay, what are you going to do next? Okay, the easiest thing to do is do something instead of going off and getting, your brain clouds over and it gets too complicated to think about it. We can set you up with a free game plan. There's no catch. I succeed by helping other people succeed. That's one of the reasons I'm here. Join a team of like-minded people. It's really hard to do this on your own, especially when everybody else is saying, well, I paid my house off. Or the stock market's on a tear. I'm going to get 20% next year. When you hear all this stuff, you don't run into too many people like me that understand this stuff and realize, oh, that's nice, that's fine. And I'm sitting there thinking, I already got 65% return on my investments. And I plan to do that for the next couple of years. And that's not even why I'm buying them. That's the icing on the cake. But the investments in real estate today really just blow just about everything else that I know of away. And I'm not even talking about creative strategies where you can end up basically having none of your own money in the property. Then your return is like infinite, but I'm not going to go there because this is not a high risk, I'm not into the high risk stuff. Don't get caught up in the weeds and miss the big picture, which is, here's the bottom line. If you want to buy real estate and you're just kind of, you don't have to be that smart to do well right now. You just need to buy it with positive leverage. Because we're in a rising market with historically low rates, historically low prices. And if you leverage with these low interest rates, it's really going to be hard to go wrong. Now, I joined a company called Strongbrook REIC, and that decision changed my life. And that's an option you might want to consider. Maybe, maybe not. Let me just say a word about them. They've got a proven track record. They're not going anywhere. I vetted this company for 5 months before I joined. Here's the big thing. It's a team effort. You're not alone. Now, this is me asking them questions for 5 months. And I finally determined they don't succeed if I don't buy real estate. Okay? This is not Amway or something. I mean, they make money by turning real estate. So that was important for me to know that because I wouldn't have joined if that wasn't the case. That's their model, though. Their model is helping investors on both sides. The people who have the cash, they got about $3-4 million. They go buy properties and acquire them and sell them to me. And there's enough margin there I can buy them below market value, and they do all the heavy lifting, and all I have to do is say, do I want it or not? It's pretty simple. Here's the deal. If you don't join a team, it's probably not going to happen. Unfortunately, I mean, it's just like getting all excited. And I know realtors, a few, who actually understand real estate as an investment. And they will be the first ones to tell you, man, this is the best time we'll probably ever see in our lifetimes to buy investment property. So if somebody else gets the properties and you know how to do the analysis because I taught you how to do it, or you can get me to help you, you can eliminate so much of this and make it happen. So anyway, if you want to dig into more details, give me a call. We'll see if it's a good fit, and thanks so much for coming.